Very good afternoon to all the members joined here, our esteemed faculty. I, CS Surbhi Jain, on the behalf of Institute of Company Secretaries of India, welcome all our members and the honorable faculty for the 28th session of EEE 4.0 Master Knowledge Series, which focuses on corporate reporting, best practices, and gateway to governance. In today's complex global economy, companies are not only accountable to shareholders, but also to diverse group of stakeholders, including employees, customers, regulators, and the communities in which they operate. As such, corporate reporting must evolve to meet the growing expectations for the governance, transparency, accountability, and sustainability. As we navigate the future of corporate reporting, it is imperative to recognize that effective reporting is not only a compliance exercise, but a vital component of building trust and fostering long term success. To address the changing landscape of regulatory requirements, emerging trends in reporting framework, and to delve deeper into the critical aspects on best practices in corporate reporting, today's session is scheduled. And for detailed deliberation on the topic, we have with us CS Ravi Varma, Assistant Company Secretary, Bandhan Bank. It's an honor for me to introduce today's speaker before all our learned members. He is the member of Institute of Company Secretaries of India and also certified as a corporate law expert from IICA. He has the credentials of being a rank holder in all academic exams with All India second rank in CS final and Calcutta University with seventh rank. He is a regular speaker on various topics on corporate laws at various forums, including ICSI, ICAI, ICMI, and various chamber houses, CII, and business schools. Mr. Varma has rich experience of corporate working in past with companies like ITC Limited, and presently he is working with Bandhan Bank. He is also a member of various task force committees of the institute and other corporate forums. It's a proud privilege to have such an eminent speaker for today's session and get benefited from his words of wisdom in this technical area. And with his brief profile, we welcome him at today's session and hope to have the enthusiastic learning. All the participants are requested to raise their queries and same will be taken up at the end of the session. Over to you, sir.
Thank you. Thank you. And at the outset, I would like to extend my thanks to you for the wonderful introduction. And before I can start, I would like to express my heartfelt thanks to our alma mater, Institute of Company Secretaries of India, for providing me this platform to interact with you on this wonderful afternoon on a contemporary topic called corporate reporting. We all know that, yes, there it is much evolving topic, and then people are more focused towards what actually to be covered and what actually should not be covered. There are certain do's and do nots. So the topic becomes very interesting for us, and we being the professional, we are treated as a custodian of the informations, be it inside the company or be it outside. So yes, I will try my certainly my I will try my best to keep the session alive with the interactions with you people, and will keep the sessions engaging one to have the insightful conversations with you all. Before we move ahead, because the topic is all about corporate reporting, and we all know that in every reporting, before we jump into in depth and get the insights of corporate reporting, like in each and every reporting, we start with certain giving disclaimer, etc. So even I would like to express my disclaimer that whatever the views I'll express are of my personal views. Neither it represents the institute's views nor it's of any organizations. So all the views should be considered mine only. And yes, obviously, beyond this, even in the case studies, etc., I will try myself resist or will resist myself from not using the name of the companies or the corporates, but still, however, if we are using it is only for the academic purpose only and for just the, you can say, to know about the cases or case details only and nothing beyond that. So now coming to the topic, when we are saying the corporate reporting, we all know that corporate reporting has become such a crucial topic over a period of time, especially with the continuous evolution of reporting standards, or be it in the, you can say, complex regulatory framework development, which we have seen over a period of years. Yeah, obviously, one of the reason is the growing demand for greater transparency and accountability, which has made the corporate reporting a buzzword for the upcoming days. Now, people do not consider it as a corporate reporting only for the purpose of or sake of compliance. It also represent the company's health, the company's inside informations, be it on the governance side, be it on the you can say strategy side. So that is what expected from the corporate reportings are. And growing torrent of information is due to, I can say, in large part due to increasing number of new regulatory requirements. So at the same time, for we being the professional, it is very much important to comply with the requirement while adhering to the laws and regulations. So, like as we look at the first side of the corporate reporting, I'll say first the tangent of those who are the recipient of this information has changed a lot. It has shifted completely from shareholder to stakeholders raising. So no longer it's kind of only you are limiting your informations to the shareholders or the investors, those who have invested in your shares. Rather, it has taken a much more umbrella shape, a broader shape, whereby you are including your customers, your suppliers, your vendors, yeah, nearby society as well, making a part of this entire corporate reporting framework. So the changing landscape over a period of time and of the regulatory expectations, it is of utmost importance for the corporates to present a true and fair, you can say, reporting. Now, when I use the word true and fair, one thing that will come for sure in our mind is that what actually true and fair could be. When I say true and fair, we look at the true and fair, even if you go by the Act under Section 129, subsection 1 starts with you should present true and fair statement. Even 448 talks about the false statement. So when we look at the like regulatory framework also, the one question that comes in our mind is that what actually true and fair could be. So see, there is no per se a defined, you can say, existing framework under the law. But yes, over the set of our set of judgments, given the changing scenario, what true and fair means is that basically the accurate, unaltered, and authenticate information. So that means the information which emerges without any deviation, which emerges without any omission, the information which emits without any exaggeration of any statement. That's the true and fair. How you reflect it, how you present it, yes, it does matter. So we'll try what we will cover today. I'll try my best. I will divide the segments into four parts. Like, let's first have a basics about the corporate reporting. Then we'll go to the key principles to understand that what actually the areas we should look into or focus into while we are presenting the corporate reporting. And the third being that we will move to the, obviously, it comes with the challenges as well. Because when we say a lot about the corporate reporting, staying on the, like I will say, first side is very easy. But then again, from the second side, the observation, the repercussions, the consequences of non-reporting, misreportings are too severe. So we'll look into the challenges and the fourth one. Then we will see that how the regulatory framework deals with it. What are the panel consequences or what are the recent cases where the companies or where the persons were imposed with the penalty for some false reporting or misleading reporting. So that's how we will deal with this today's topic on the corporate reporting. So when I'm saying on this first slide, so coming back to that, the shifting of, you can say, the people who were recipient for the shareholders to stakeholders, I was trying to focus that mainly it is of two segments now. If we look at this, it has come like financials and non-financial reporting. So when I look at the financial reporting side, I will say the financial reporting still continues to represent the health of the financial health of the company, be it in the balance sheet numbers, be it the PL, be it in terms of a cash flow, it continues in the numbers. So still financials are the quantitative factors, financial health of the company. But there is a growing trend for the non-financial reporting because over a period of time, it highlights that the companies are also shifting its focus towards non-financial reporting. It's more on the qualitative numbers, but yes, at the same time, despite having the numbers only, it represents the overall health of the company. So I will say the financial used to be a particular checkup for the company, whereas the non-financial reporting is a particular or in the entire overall checkup of a company, which represent be it a financials, be it the number, or be it on the other side about the company's process, about the company's procedures, the company's governance practices, all get reflected when we represent or when we present our non-financial reporting to the stakeholders. So in a like detailed structure, if you look at this, that what actually it is, that financial and non-financials. So even if the looking at the provisions of the act, the financials, basically we are covering the financial statements, RPT reporting, we are covering the notes to the accounts. If like even if you say it starts from section 2 subsection 40, which deals with the financial statements. In the financial statements we have got like cash flow statement, balance sheet, PL, statement of changes in the equity, all those forms are part of a financial reporting. When we say RPT reporting, why exaggerate separately on the issue? Because there have been a lot of precedents, a lot of observations coming from the regulatory bodies in the reporting of related party transactions, etc. And special focus, be it from the Companies Act side, be it from the CB side, is equal on the reporting of related party transactions. So even 134 subsection 3H do talks about a separate reporting of the related party forming a part of the board's report, although, but then yes, it comes there only. And then if I look at the CB LODR provisions, regulation 23 particularly emphasize on the disclosure of those transactions. So these forms are part of a financial reporting. Notes to accounts forms an integral part of the financial statement. Whereas on the non-financial segment, if you see the in India, we have seen quite a, I will say, landmark change. Starting from the regime, like though it's again not a new concept for India. It's coming all the way from mythological. If you go more deeper into it, you'll find that it's all start from our ancient times where we used to give equal importance to the surrounding living being, be it the green environment. So it's all coming from those culture only. Now we are focusing again back to it because it's again a cyclic period. So the more focus has emerged towards sustainable reporting. Even it has become a mandate now by way of a BRSR, business responsibility and sustainability reporting. But then prior to that also, there was a focus on it because many of the companies in India, leading companies, have adopted the practices of coming out with the sustainability reports. So it's no longer that it started just because of this statute only. It's there way behind. We have started this sustainability reporting separately. Yes, obviously with the regulator focus, now the companies are encouraged both from the regulator expectations as well as the voluntary adoptions to adhere to the requirement for those non-financial reporting of the BRSR, that business responsibility and sustainability reporting. Now the CSR report being forming a part of the board's report also emphasize on the need to focus on the non-financial parameter. Of course, one might have a quick observation that it does talk about the numbers, but it has a mix with both quantitative and qualitative. So if it talks about the number, what is the threshold you are required to expand, then it becomes the quantitative. But the area where you are incurring those expenses, what are the strategies of the company, whether it's on more focus on the ongoing projects, more focus on the implementing agencies, or more focus the company adopts on its own, are all reflected through the CSR, thereby building a chain of trust and the loyalty with its stakeholder. That's a chain how you communicate through this non-financial reporting, which you will hardly observe in the financial part. You will get that kind of a bond connections with the stakeholders. And then secondly, on the non-financial side is the sustainability reporting. So sustainability reporting, as I already mentioned, it's a still it has formed a part of the BRSR only. It has come out, not come out separate report to make a part of the non-financial report. Though in the Western, like you can say, the international practices, many companies, many global standards are there to encourage more adoption of this sustainability reporting. In India, also few of the companies are publishing separate sustainability report to emphasize more about their initiatives, sustainability initiatives, and to engage themselves with the stakeholders. Because this is the perfect way how you communicate, how you reach, how you create a chain with your stakeholders through these sustainability measures. Then on the non-financial reporting forms your disclosure, your statute, whether it's a statutory or voluntary. Why I say the disclosures forms a part of this, the reason being disclosures are the factors to motivate the company for the proper reporting. Because if you look at the practices, one common prima facie view in a legal world, we talk about the prima facie view that comes from the disclosures itself. How apparent you are, how absolute you are, or how adequate you are. Whether it's just like a compliance box ticketing concept, or whether you are disclosing it properly with some additional information to make the investors understand, or you are just meeting the regulatory requirement on a stringent basis. So this disclosure somehow motivates the culture of a company, the employees of the company, the staff of the company to adopt that kind of ambience where they believe in making a disclosures from time to time. So this is all about in Indian parlance. Now I'm talking when like we are still, though we are coming out with the BRSR sustainability reporting, we are at you can say par with the pace of international standards. There are many international standards that has focused on the non-financial reporting, and they are emphasizing on the need to publish the non-financial parameter forming an integral part of the reporting. So just to have a quick look, there are many amongst them. Like I will talk about the few of the key eminent standards which are emerging is the Global Reporting Initiative, the GRI. The another one being the task force, which was for the climate related. Then another one is the IIRC, the International Integrated Reporting Council. And last, the Sustainability Accounting Standard Board. Now, these four also are having a core element of focus on the non-financial parameters only. When I talk about the GRI, GRI is in nothing in nutshell a framework of ESG. And it has a four principles. In fact, the GRI G4s are the four principles which focus on the materiality, stakeholders engagement, inclusiveness, sustainability, that how they get into the culture of this, and then completeness, that how the reporting or how the you can say disclosures, whether they form a part of a complete requirement for the stakeholders, whether they are meeting those requirements which are set by the global standards to provide the investors proper information on that. So that is what the GRI is. The task force and the GRI is having, you can say more or less same. The only line of deviation between these two standards are task force are more oriented towards the ESG factor, which is more related to climate related aspects. So this makes a differentiation between the GRI and the task force climate related financial disclosure. The last two are the IIRC and the Sustainability Accounting Standard Board. In any case, the International Integrated Reporting Council is what we are aligned with. Like, as we all know that we have already adopted the regime of BRSR, coming out with our separate report forming a part of annual report, which comes as a different section BRSR. In many companies, they have already started coming out with the integrated annual report. Including these reports, there also the non-financial reporting to make them to make the investors here take decision, because they no longer are only part of a you can say profit or earning. Now they are a part of your policy decision making also. So you have to bear that factor in mind, and considering that we are already aligned with the IARC norms. So In Indian and IRC norms are almost similar. And the last one is a Sustainability Accounting Standard Board, which again will take time because this, if I have to say anything about the SASCB, I'll say it's purely towards the sustainability. It doesn't focus so much on the material part relating to the financials, though it has again five dimensions, which all starts from environment, social capital, human capital, manpower capital, and then business model and innovations. So it remains focused on the quality and performance rather than the quantitative numbers. So these are the global trends, which again gives the impetus to the Indian practices or Indian global reporting standards, which we have already adopted. Now, having said that about the international standard, the another quick observation have in mind that yes, absolutely, this is true that yes, obviously the demands and the expectations are changing. But what all the other factors are there which truly necessitate the demand for the corporate reporting to deliver the best to their expectations. It just can't be the one only the shareholders' expectations. There are plenty of factors which I also endorse. Yes, there are plenty of factors. If you have to see the entire reasons which necessitate the demand for reporting is that the accountability, that expectations of shareholders, expectations of regulators, because even there is a regulatory framework demanding from you the disclosure in a particular format, disclosure of particular informations, disclosure within a particular defined timeline, disclosures to particular kind of a stakeholders. So they have also segregated or filtered their requirements. So you have to meet the regulators' expectations as well. Then in order to continue or sustain the performance, the impact on the people, environment, and society is much required. And that you create through your reporting matrix. Then, yes, sometimes companies, entities are having a proper planning, or you can say pro planning for their fundraising, for going and accessing the market. So, from that perspective, they always believe in a good practices or adhering to the good practices for reporting to make it easy for them to assess the investors and the stakeholders. And then changing demographic of shareholders and latest technology are also becoming, you can say, the grounds for the necessity of a reporting. So these are the all grounds which truly reflects or which truly says the necessitates the requirement of a reporting. And what impact it has on the society is that the it reflects in a multiple ways. There are benefits coming out from the corporate reporting, and that is what the reason the companies are adopting to it. Even the you can say if you go to the S&P 500 companies database, it has been found 60% of the companies have already adopted those practices. Yeah, of course. How much efficient, how much data producing they are, that's a different study or stats you can say, depending on the kind of they're dealing with the stakeholders. But adopting the practices is a big challenge, and they have already adopted. So that's a good, you can say, move from the India Inc. world that we are shifting towards that regime where we believe that corporate reporting for stakeholders is of utmost importance. It reflects your procedure. It mentions about your regulatory compliances. It presents your companies and board performance. It also narrates about the board role and responsibility. And then, yes, obviously, it talks about how efficient the governance practices are there within the organizations. So when I say procedure, how you will get the idea about the procedure? Like say, for example, when you look at the report, there are certain, it reflects the quality indicators in every report. So what can be the quality indicators like governance? What is the specific process companies are following? A specific process in the sense, say, for example, in some of the detailed annual report, you will find that they completely narrate down the procedure that how the agenda flows from the department to the board, and then it goes to the board for its decision, and then outcome of decision is communicated as a part of ATR, action taken report, and then whether what are the, like, again, next stage post the ATRs comes out of it or emerges out of it. So that shows that how specific you are about your processes and procedure you are following. So that's a true reflection coming out from the corporate reporting. Then obviously when I talk about the regulatory compliance, in some of the annual report, you'll find there is a, again, checkbox requirement, ticketing box. So that means strictly adhering to the regulatory compliance. But then some of the report you'll find they are going something, or they are providing something in addition to what actually the regulatory requirement is. So when they are providing something in excess of the regulatory requirement, it is also equally important for them to understand its implication, because giving the voluntary disclosure also needs a rigorous study within the organization, which will deal with it in the upcoming slides. Like, say, for example, regulatory compliance, we all know that uh, in the January 2023, SEBI has mandated for the top 250 companies from the FY 24-25 to adopt the ESG core as well for their reporting purpose on a comply or explain basis. So here the company has that view to either comply or the explain that what are the reason they are not able to comply with. So that also becomes very important when you are adopting the mechanism of regulatory framework to adhere to it strongly or not. There's company performance, obviously. These both qualitative and quantitative number comes out very clearly when you are presenting your report to the investors. Obviously, here the data accuracy, data integrity all plays a lot. All has to be kept in mind that whatever the data is being presented to the stakeholder should be checked thoroughly, and the data should go absolutely accurately to the stakeholders. Then comes the role of a board role and responsibility. So board role and responsibility, I will just take up in the next upcoming slide, because we all know the board has a much broader role here. The responsibility of the board is of much wider. They are, be it in the Companies Act, their duties is vast. They are acting as a trustees, and then it is, like you can say, it is their duty to take safeguard or to safeguard the assets of the investors, those who have invested in that company, and to retain their faith on a continuing basis is a big challenge for the board of directors, because their prudent call, their wisdom regulates the market, regulates the investors as well. So the board role and responsibility, we take it separately. And then obviously it reflects your effective governance processes. Now, obviously, when I say governance process is all about how you reflect. Overall, the corporate reporting gives you the, you can say, score to your governance practices. Because when you are very clear, when your reports are very accurate, transparent, and having a very clear communication with the stakeholders, it gives a confidence to the stakeholders, to the investors, that yes, they can rely on this company. They can branch upon this company for the purpose of investment, for the purpose of dealing. Because when we are talking about the non-financial reporting, the difference is that the financial reporting is mainly from the investors with a viewpoint of returns. So we generally produce the data, we give the data to expect that, okay, the investors will invest in expectations of a return. But the non-financial reporting is completely different. It's producing information to the stakeholders, it's producing information to your customers, vendors, suppliers, to encourage them to engage in dealings with you. More than numbers, it's all about the connections. And that is what the benefit comes out when we talk about the effective governance. So these are all impact a corporate reporting creates when they deal with the situation of a corporate reporting. Now, having said this, the legal framework which deals with the corporate reporting is not on the financial side. There is a common myth, or there is a general, you can say, I will say generic myth, that it's only all about the financial reporting. There is no such legal framework for the non-financial. reporting. So it comes for both. It's not that the only financial reporting are isolated. The statutory framework controls both, be it the financials and the non-financial. So just to have a quick look, like if you look at the statutory framework which deals or which regulates the reporting, the Companies Act 2013, which deals with the like which regulates, you can say section 129 governs the provisions related to the audited financial statement. Then there is a 134 which deals with the board's report, presentations of board report. Then there is a requirement under section 135 read with the rule 8. It requires the CSR report forming a part of the board report. So see, these are the reporting requirement which emanates from the Companies Act. Then comes under the SEBI. It's not only this Companies Act which governs the regulatory framework for the reporting. In fact, SEBI also has a provision like for the CG report, the corporate governance report, Schedule 5C of the LODR, that listing obligations and disclosure requirement regulations. It basically requires listed entities to come out with the detailed report, a detailed section in the report of annual, which is called corporate governance section. Thereby, you are providing n number of informations from your committee constitutions to committee frequency to the numbers of committee meetings you will have and ending to the number like about the company's general meeting, company's number of shareholders, entire process of whistleblower, investors, nodal officers. So all those informations are reflecting in the this section of corporate governance. And this section is governed by the Schedule 5 to the SEBI LODR. Then there is a requirement of coming out with the MDA, management discussion and analysis, which is again a non-financial part of the report. Why it is non-financial? Because MDA requires the company to disclose the industry, you can say industrial sector performance. It is also required to produce the informs or provide the opportunity and threats, the details of that. It also provides what are the risks and concerns that the company is anticipating or company envisages in the upcoming days. It also needs to provide the outlook of the company's segment-wise performance. So all these comes under the MDA, Management Discussion and Analysis Report. This is another section which emanates from Regulation 34, Subregulation 2E, and read with Schedule 5, which you need to provide to the stakeholders called Management Discussion and Analysis. And then comes the BRSR report, which is purely non-financial in nature. It is also emanating from Regulation 34 2F. It basically requires the company to publish the data based on the 9 principles or 9 indicators identified for the sustainability reporting. So there, in terms of, in accordance with the Regulation 34 2F, you provide the complete BRSR report of the organizations covering the parameters, covering the principles. The principles are again divided into two sub-segments. The one is the leadership approach, and the second one is the compliance voluntary approach. So that means one is you are giving the data, what actually the company is doing, and the leadership indicators, that means what additionally you are doing too. So there also you are providing in the non-financial reporting in terms of the SEBI requirement or the SEBI regulations. Besides these two framework of your Companies Act and the SEBI, from time and again, there will be a lot of advisories, lot of, you can say, the guidance note coming out from the stock exchanges or other enforcement agencies from time to time for making certain disclosures. So if you look at the advisory part, I will say the stock exchange from time and again have issued guidance, to the companies. In sometimes you will notice that stock exchanges are issuing warning letters to the company or seeking clarifications from the company in respect of certain rumor going around, misleading informations going around. So that also becomes very important for the company to consider while reporting, because that also forms a part of your reporting. That also forms a part of your, you can say, following all the process which you require in any case for the diligence reporting. So that becomes very important. Then second, Advisory and guidance notes also at times, like there are in many regulations like PIT, SAST, and the PFUTP, where you require to report certain kind of a transactions you're dealing, your uh, request for seeking exemptions from the regulations, etc. This also becomes very important because this at times requires a proper disclosures, proper dissemination to the market, and thereby developing, or you can say, set up a ground for your good reporting. So this is the entire framework of your regulatory laws, regulatory regulations, which requires the entities, which requires the corporate to make a complete and concise reporting. Now, despite having this, so far what we discussed is all about that how the corporate reporting is changing, what are the non-financials and financials, how it helps, how it impacts the outer world, and then the statutory framework which regulates the entire reporting, whether it's a financials, non-financial. Still, there are certain practices which are discouraged presently nowadays because these only not only creates a misstatement, or you can say a falsification of the market, but also may result to the penal consequences. Like of late, it has been observed there are so many cases where the companies have adopted a practices of window dressing. So window dressing, when I term this word, it's again, it's not only the companies that, as a profession, it is our duty to see and verify. Then are we really compelled to do so? Because, in a competitive world where the companies are having no choice other than winning the hearts of stakeholders, what they are doing, what they are turning into, exaggerating what actually the situation or the position is, and thereby resulting into a window dressing. So this is just nothing that meeting the increasing expectations of stakeholders. But that should not be a driving factor for the corporates because that expectation is not necessarily required to be met on the day one only. It's their expectation. It can be established gradually as well. So as a professional, it is your duty, it is our duty to ensure that the company's entities should not run into making these kind of window dressing statements or reporting. Rather, the reporting over a period of time can be further improved, can be further corrected. If you look at the big MNCs, the top companies, their annual report has shown a remarkable improvement. In fact, without quoting the name, there are two, three annual reports where you'll see the companies give the statement that the company is in the process of setting up the robust mechanism for its risk management assessment and to create a library of risk. And then in the subsequent annual report, you'll find a more detailed report coming out on the risk vertical. That shows improvement. So one should avoid window dressing. In fact, in one of the judgment recently, NCLT Chennai, it was held that even the company was indulged and one auditor was also involved in the window dressing of, you can say, the accounts. And then there was a penalty on both the company side as well as the auditor side, because what actually the outcome was that the commercial decision to cancel these shares cannot be approved by the NCLT because of the falsification of accounts or window dressing, because this scheme was pertaining to the cancelment of shares. So that gives a clear signal that this approach, this uh, methodology adopted by the corporates will no longer be tenable in the market. Then similarly, this kind of a practice again in the non-financial window dressing is for the financial, is a coin word which we use for the financial word. Then for the non-financial side, there is another coin word which we call is greenwashing. So that means again you're exaggerating your sustainable practices, which is not something in realistic. So presenting more than what actually in your reality. That also is not justified from the corporates. That is not encouraged at all. So greenwashing as again can lead into a penal consequences under the act. And there is another concept called green hushing. So green hushing is that it's nothing. It's just like where you don't want to give a disclosure at all. Greenwashing is something exaggerated, and green hushing is that you do not want to come out with those information. So these practices should be stopped or should be meticulously checked by the professional before ensuring its dissemination going to the market. Then there are certain incidences where reporting are misleading the market because to create your image or to create a situation for the shorter period. Why I'm emphasizing on the shorter time period? Because the reason being, this may create a ground for you in the short term, but the long term value chain will not be created with the misleading the market position. So these practices are having penal consequences are not at all appreciated. And the another concept is the sandbagging. What you do is basically you underestimate yourself. Your projections are very low. Suddenly you perform in outstandingly performance is reported, which gives a pump to your market. And then the people make profit. People do part their, you can say, shares also during that period, pump and dump and sandbagging has an intercorrelated relations. So these practices are discouraged and no longer you can say the investors are paying attention to these kind of entities which are indulged into it or which has come out in this. So for us, the time is that we should know that what are the penal consequences we can have. We should not get indulged into these practices while presenting our annual report, our corporate reporting. Because obviously, the corporate reporting, even if it's not exaggerated, even if it's not underestimated, even if it is a true reflection of what exactly the position of a company is, trust me, the confidence of the investors will remain high with the company. Compared to the different situation where the investors' confidence will be turbulated because of the market reporting or misleading reporting by the companies. So these are like some of the practices I wanted to highlight that these are not encouraged any longer by the investors, especially giving the scenario where the changing landscape of environment is emerging. Now question comes like we have discussed the regulatory framework. Now there are some misleading practices are also adopted and there are going to be penal consequences as well. So actually who could be responsible for those reporting? Who should be held responsible for like not complying with the requirement? So my simple answer will be that yes, obviously the board of directors, board committees, and management. All three together will make a vertical for the responsibilities. Why I'm saying all three? Because it cannot be only the board of directors. There are so many judgments where it was held very clearly that there is a vicarious liability clause that it says that the one director is to be involved into it. It has to be proven that he was the director at the time of a commitment of the offense. And second being, his involvement is of utmost importance. Even if you look at the CB LODR regulations, read with 149.12, which are called safe harbor provisions for the directors, independent and NED, that says very categorically that if he has acted in connivance or with others. So that means if he is not having a privy or not being involved into such kind of a false statement, giving misrepresentation to the market, directors will not be responsible. So considering that, it is equally important for the management to understand that there are roles of a committee and management as well. So now being board on the top, if I say board is responsible, we all agree to one part that board plays a vital role. Board act as stewards of the company. The board has got a lot of time to execution, like strategy goals, objectives, vision, fulfillment of targets are all remaining this, you can say, the responsibility of the board. Even the board are supposed to put mechanism in place to ensure the continuous monitoring of the progress of the performance of the company. It's their duty. They are also responsible for the oversight and governance. Then where they have to look at the entire scenario that what actually the company is doing, what the companies are reporting. What reportings are going to the stakeholders, what are the reactions of the stakeholders, is the complete duty of the board of director if I look at the broader angle of oversight and governance. The second important role for the board remains that yes, it should also comply with the regulatory requirements, because that's very clear, that's a very known to all of us, a general statement that they are the one responsible for making the company comply with the requirements or evolving standards as far as the reportings are concerned, failing which the company and the officers and directors will be liable for the penal actions, be it in terms of penalty and fine. So that's the second, you can say, commanding functions of the board. In fact, beyond this, the board is also responsible for providing strategic oversight. So strategic oversight in the sense not limiting itself to the role of collating informations, giving their judgment, giving a, you can say, decision, proving items. It's more than that, they are moving and making a shift towards the changing strategy for the company, making the goals aligned with its strategy, making the management's ideology aligned with its strategy. That's also the supreme, you can see, the fourth power of the board. And last but not the least, the board is also responsible for the stakeholders' communications. That also remains very one of the vital duty. So these collegial duty we have read a lot somewhere in some authored books, somewhere in the, like you can say, we talk about the governance practices, you will come across this. But I'm emphasizing more on the regulatory requirement. Even if you look at the section 166, it says very clearly, it's section, a particular section dedicated to the duties of directors. And that is 166. No doubt, 2014 Companies Act 2013, when it was got enacted in 2014, a new regime for the duties of directors has emerged. It was there in the UK Companies Act, it was there in the US SEC rules, it was there in the European rules. The directors' duties were defined. The directors were supposed to act with the due care and reasonable assurance. But that practice of business judgment has got converted into a regulatory requirement under the Companies Act 2013, which says categorically under 166, a director shall act in good faith in order to promote the objects of the company for the benefit of its members. So that means there should not be adoption of any fraudulent practices, any false, misleading creation of market, exaggeration of statement, underestimation of statement, undervaluation of parameters. Nothing is permissible. They need to ensure that they promote the objects of the company. They are required to act and discharge their duty, exercise his duties with the due and reasonable care, while ensuring at the same time the proper diligence. And there are so many cases where the directors were held because of the mere negligence on their part. So it is of utmost importance being a director, the one has to exercise the proper diligence, and that comfort will be given from the professionals, be it in the whole time company secretary employment, practicing consultant, but that comfort has to be drawn from them, and the director needs to ensure that there is a thorough check on the executions of their functions, what is required under 166. Not only 166, similarly, there is a section 134.5, which says about the board's report where you will provide director's responsibility statement. So the DRS itself means you are accepting your responsibility. So in there, you from A to F, you provide whether the applicable accounting standards covered or not. You give a confirmations. You also give a confirmation for safeguarding the assets. You also give a confirmation for preventing the and detecting the fraud in time. The directors also give the confirmation about the internal robust internal financial controls and the compliance system. So now see, when you are giving that responsibility, the the consequences of it is maximized, because in many of the judgments, in fact in two of the landmark judgments by the apex court itself, the honorable supreme court held it very clearly that what they have analyzed, there are two coin terms before they analyze the responsibility of director. The one is in charge of and the another one is the responsible to. So what their view is that the in charge of word requires a factual test. So when you say person is in charge, it needs examination whether that person was really responsible, whether is a clear cut authentications for the person making in charge, whether the person was doing that or handling that matter or executing that matter. Whereas the another one is responsible to is a legal test. So even if it is legally defined, either of them, this test, if fits in, the directors become responsible. So in order to ensure that the duties are properly discharged, it is of utmost necessity that while giving this statement be correct, because there is one or two cases which we'll discuss while directors were held responsible for giving false DRS also as well. So this also becomes very important. And then when companies act gives a lot of, you can say, insights on the director's duty. CBLODR says, yes, we do have certain principles, like particularly Regulation 4, which deals with the principles of governance. And this says very clearly that the directors are responsible for ensuring the integrity of listed entity when it's coming to the financial reporting system. Though here again emphasis is still financial reporting system, but that makes it very clear the integrity role of directors is there. And the continuing with that regulation 4 only, then you go to the sub regulation 8, it says that the directors are responsible for overseeing the process of disclosure and communication. So that means even by virtue of that, directors are becoming responsible for whatever you are communicating or reporting to the stakeholders. Beside this, there is an add-on through the regulation 17.3, where the directors are required to review periodically the compliance report. And the compliance report, yes, of course, that means overall compliance, confirming that, yes, the reporting matrix is also in compliance. The standards have been adhered to while making a disclosures or report to the stakeholders. And in as far as the SEBI regulations are confining to that only, like I will say in the duties of directors is coming from Regulation 30, where it says the board of directors with the sensible mind they will authorize someone to determine the material event. Why it has been like again kept limited, or you can say the power being limited to the directors is to apply their due diligence while authorizing. Because these material, once it is decided, it will go into the market. So there should not be no manipulation. So in order to have this practice through the legal framework, there exists Regulation 30. So see, these are the various there are various other regulations, other sections as well, regulating the functions of the board of directors. Nonetheless, beside these roles of the board of directors, there exists the role of the committees as well. Because in when we talk about the role of board of directors, we do have a ton of thoughts that yes, obviously, role of a board of directors by virtue, by without law also, they can be held liable, being the trustee, being the one who the management believe or who the company believes that they will run the management. So the company is run through the board of directors, and in any case, they are the front face of the company. They can be held liable. But in many cases, it is equally important for us to understand the committees are also responsible, or committee has also been held responsible. Like if you look at the regulation 18, read with part C, the role of audit committee has been defined. The role of audit committee includes the oversight of the financial reporting process of the company, as well as to review the company's MD, management discussion and analysis report. So while discussing the management discussion analysis report, I just now mentioned that management discussion analysis report indirectly forms a part of non-financial reporting. So see, in non-financial reporting also, the role of audit committee gets triggered. The role of audit committee is also required to look into those aspects before reporting, before disclosing it to the market. And there comes the role of audit committee. In fact, this is not the regulation saying there are judgments. There are many judgments where in the many popular cases also where the audit committee members were held responsible for falsification of accounts. It has been clearly held in many cases that the role of the audit committee envisaged is with the proper handling of accounts and information. So if there is any gap, if there is any leakage, is all fallen soul the one role audit committees comes into the picture. Now, when I see the role of the audit committee, one quick question you might have in mind that is it only the role of audit committee which is more focused towards the reporting, or should we say all the role of the committee? Because that may be another curious questions coming in mind that why not confining it to the role of audit committee only? So I'll say not only audit, it goes beyond that. Even if you look at the proxy firm's report nowadays, given the data, I will say until 2023 that they have produced the data. Almost like say, for example, one proxy firm SES, they are saying that 8,000 recommendations they are proposing 2,000 to vote against. Why the reason being, again, in many of the issues, many of the resolution, the flag marks was that either the director's continuation considering the conflict of interest or inadequate details relating to the remunerations or certain statutory actions pending against the directors, which again put all together a flag mark for the continuations of those directors, which are being recommended, the appointments of which are being recommended by the Nomination and Remuneration Committee. So the role of NRC is under the continuous watch by the proxy advisors. So no longer it's limited to the audit, it has gone beyond that. In fact, all the committees has come into the picture. Going forward, sooner, like the risk management committee, which we say is a purely dedicated committee to oversee the risk planning, the risk framework of the company, that will also come into the picture where there will be slippages of risk or where there will be some non-adherence to the risk requirement or it will emerge in a particular kind of a situation. So board committees, everyone gets tangled into it. Management is not left behind even because it is, of course, the most important duties of management. How the management can ensure that, how the management is the responsible for that. There is a clear-cut regulation 4 of CBLODR, which outlines the role of management. It doesn't mean that one quick observation one can have. If it's a role of management under the LODR, then is that same requirement required under your Companies Act? So one can have a quick observation, though Companies Act do not clearly envisage or then it clearly prescribes the duties of management. But yes, the management also responsible being there also to ensure that disclosures of requirement, reporting requirement. Because what are the expectations of the regulatory framework is that the first, the information shall be prepared and disclosed in accordance with the applicable standards. The second is that they shall refrain from the misrepresentation. So that means they are saying they should not indulge into a kind of a practice which will misrepresent about the company. They will provide the adequate and timely information to the stakeholders. The information interesting part is that, see, a good reporting is the one which is having a more accurate, more adequate, explicit, timely, and in a simple language so that the one who are the recipient can understand that what actually you want to communicate. And these are the essentials which are inbuilt in the LODR itself. And you can say encompassing the management to focus on those aspects of reporting, not making the complex structure of reporting, rather be in a simple form, the accurate, adequate, and timely. In line with this role of management only, that there is a NSE has come out with the advisory. So even the stock exchanges are very particular, or you can say very, very much pro on the coming out with such measures. In fact, the NSE has come out with the requirement that The guidance note they have issued in June 2021, which mentions certain do's and do nots for the good reporting, or you can say disclosure. Why they have mentioned this, why they have come out with this, because they have also noticed that there are certain misrepresentations, certain wrong informations are flowing around. So in their simple, that makes it very simple for the holistic approach of reporting. What are the do's? They are saying that statements shall be truthful, fair, and evidence based. So that means don't disclose anything for which you don't have the supporting. Then it says the information shall be clear, concise, and understandable language. So that means you should make the disseminations in the language which gets reflected, which conveys the message to the outsiders in a very clear way. And obviously, the uses of simple and easy to understand language. So, not using the jargon, not using these complex languages or reporting in the complex environment. They are saying that that should be the characteristics of do's. Then there are certain do nots. What are the do nots? Do nots is that the statement shall not be manipulative, the statement shall not make any promise or false statement. Going forward looking statement, even if you know, it has to be supported by some supporting informations. You just can't make a promise that, okay, you will do this, you will do this. So that discourage the forward looking statement if it is made without relevant data. Right. Again, I'm saying without relevant data. It's not that they are not encouraging, because we all are encouraging for the forward looking informations. In fact, nowadays, many companies are adopting the practices of forward looking information. But what actually presently is happening without supporting data, it becomes challenging. Then it mislead the market. Then it creates a kind of a, you can say, the investors bias towards making a decision. So, in order to stop those practices, it has been encouraged widely to ensure that even if the forward looking statement is given, then it should be supported by some number. So, given all this scenario, given all this responsibility, when we discuss about the management duty, when we discuss about the board of directors, when we discuss committees, it is our duty as well as a role of professionals to ensure that the reporting goes in a correct way. So, we play a role as a connector, as external value focus, as governance and oversight, and then communication. So all these four verticals are very important for us to understand that as a professionals, we can also be able to deliver our best while adhering to the good practices of corporate reporting. Because as connector, we are the one who can connect on both the external and internal ambience. External value focus, we are the good in judgmenting that what actually the investors' minds are, what are their expectations. Keeping a tab on their expectations is very important for us to keep that as a professional. Then governance and oversight. Governance and oversight, that means you have to look into the good practices, be it you are following some others, you are on the path of some other entities or companies, but then at least setting some benchmarks. And then be good in communications, because one frequent communications and the continuous engagement also makes our reporting also establishes good practices for corporate reporting. In fact, if you do not discharge your duty as a like good corporate professional, there are so many cases. In fact, like there is a one case we all know that the Bombay High Court held that, though in that case they have restrained SEBI to take any actions on the professional, because being governed under this separate statute, but in the same judgment they have clearly mentioned that if there is any material against the professional, and that it is proven that he was instrumental in playing a role in that or in falsification of information, then SEBI is empowered to initiate action against the professional as well. So that means it's a open window by the Bombay High Court for the SEBI to decide the penal consequences on the professionals as well, for the wrong reporting. Not only this, even the MC at times has held for the wrong certification. We all know that one of the prominent case which came across us is that for the wrong certifications of the annual return, professional was penalized to the extent of a penalty of rupees 2 lakh. So just see how the dynamics are changing, the regulators' views are changing, be it board, be it a committee, or be it professionals. The adherence to the best practices is required from all the corners. So this was on the rules now. Now, after studying the corporate reporting, the statutory framework, the roles and responsibility, next comes ki why we are adhering to the path of governance. Why it is of utmost essential for the corporates to be driven on the path of governance. See, I will say not governance, it's rather enhanced governance. We all know that there are four gatekeepers for the governance. The one is the management and board, the second being the regulators, third being the auditors, investors, and analysts. So, from the regulator's prospect, I'll say they already expect the management to develop the best practices. In fact, many of the laws, stringent provisions we all know has been changed for the sake of or the comfort of corporates to adopt on the voluntary mode. So this is what the regulators are doing towards the enhanced governance. Now, from the management, auditors, and investors, is that from the management and board, the best practices of corporate reporting can inculcate the culture of good corporate governance, can create a good footprint for the governance, because we all know there is a famous saying, the charity begins at home. So, in order to create that corporate governance ambience and the expectations from the investors, for a fair treatment, for a fair view for the company. It is the first that should start from the company, the footprints of good corporate reporting. And then auditors being, you can say, trusted upon a very responsible duty to monitor and report the internal findings. Now, like we all have a good news in place that SEBI LODR also mandates a secretarial auditor's appointment for a period of 5 years in line with what actually the statutory auditors is, and that too by the shareholders. So in the shareholders democratic world where the demography of shareholders is governed by the democracy, and thereby appointing the auditors with such a huge responsibility, is their duty to fulfill that responsibility and obligation to present a fair report to the stakeholders. And then the investors are also expected to adhere to the best governance principle, because that's the reason if you look at the regulation 30, the investors meet disclosure, the presentation disclosures are all emanating from that, because you cannot just take benefit of what you are in a possession of. Merely being research analyst, merely being investors, you should not have you should not make some compromise with the information what you have received from the entity or the company should not compromise its position, but in terms of transparency is very much required. So now the regime has shifted towards the enhanced governance. It's not only the governance only. And what are the factors that will make the enhanced governance is motivation, method, and meaning. Motivation, you have to look after that what motivates you. So what motivates you, you have to find out the factor. There can be, say, for example, there can be a whole lot of things like statutory requirements I have to do, but then there may be some voluntary disclosure require to make. I should adopt that. That's the motivation that will come from. The method will depend what actually I'm going to disseminate, like the information which I collated is whether it's internal, external information. I should collate the informations with the supportings, because merely just passing on the informations again is not a rule of an organization. So the method you should check and the meaning. The meaning is very important because ultimately I have to see the impact of what actually I'm disseminating to the market, what actually I'm giving to the market. So these are the principle one should adhere to while giving this disclosure on the enhanced governance reporting. Now, so far we discussed on the regulatory part, the rules part. Now, how can you make your report a completely different? Before that, there are certain five principles one should bear in mind. There are five principles of good reporting is that one is the transparency and accountability. The another one is the informed decision making. Third being the regulatory compliance. Fourth being investors confidence. And the fifth being stakeholders engagement. All these five principles together make a complete, concise reporting, corporate reporting. Now, how does it play a role? What are these? You can say there are plus points, there are minus. So it's not like that. Life is always it's kabhi khushi, kabhi gum. So there are like when I look at the one side, it may have a lot of good things coming out in the hands of professionals, but at the other side, it will have challenges too. So the challenges part we will take on, but before challenges part, let's understand that these principles, how you can build in and what can happen, what will be the consequences if, say, for example, I do not adopt to the practice of transparency and accountability, and what benefits I will have if I adopt. So see, transparency and accountability, it includes everything from statutory to voluntary. It's no longer that only the statutory part you will disclose and you will be transparent in that. It's in all, be it the regulatory or be it the voluntary. It requires transparency in everything. The accountability, while refers the other part, it is more so taking the onus of metrics that you have informed to the stakeholders. These transparency and accountability together foster a culture of trust of the investors that you will build up because the investors' trust is the gain towards the corporate reporting. For you, the stakeholders are the one who are the ultimate recipient of those informations or these information. So for them, these two elements has to be clubbed together and they are very important into like you can say in the reporting because being critical in producing meaningful disclosure. See, otherwise, the entire purpose of the disclosure may turn futile. But these two are the main essence which will make your disclosures meaningful. And that is what the expectations are also. If Regulation 4 just we have discussed, it also very clearly emphasize on the need whatever you are disclosing are clear and whatever you're disclosing are adequate, putting the responsibility on the management. So management adopts the accountability and ensure its transparency of this information flown to the stakeholders. Now, if say, for example, you do not adopt to, I will give the examples like in one of the case, it was held by the SAT that though they have reduced the penalty amount was somewhere around 25 lakhs to 10 lakhs, considering some of the grounds by the company that they complied, but they complied at a later stage. And in some stages, they do not disclose at all. Like they were compromised with the conflict of independent directors. So that independent directors continue to act as such. And later on, after almost a period of 4 years, they have been redesignated as non-executive because of the conflict of interest. So the remedial action the company has put in place before SAT that see, we have complied with the requirement. It's no longer a violation, but then it is not transparent. It is not accountable. The accountability would have arisen. It was held by the SAT that accountability has arisen the day the conflict of interest was compromised. So if you're coming at a later stage, making the compliance good will not make the penalty completely waived off. So it has been reduced, but not waived off. Similarly, there are so many cases. In one of the cases, the company failed to disclose they have disclosed the items, but then there was certain misclassification. It was held in the MCA order only. The case pertains to the PPS export and import. What actually it was held? There were certain reclassifications of items. The company reported its related party information in a different manner, not in a particular format. So for all these, there was a penalty imposed. Why? Because the transparency and accountability compromised. What benefits it will have, you can see on the screen, it avoids legal pitfalls because the more transparency, the legal pitfalls will be reduced. It upholds your standards. It maintains positive relationship with the regulators. As I said, like when you try to place your non-compliance before the regulatory body, at least you can put your ground that yes, you are in compliant, you tried your best. So these are the like benefits which comes out from the transparency and accountability. The next comes is the information and informed decision making. So when I say informed decision making, how it becomes important and why it is important, why one should consider. It is a very very common thought process which will come into mind. I will say informed decision making is very important for unlocking the values. Why? Because the reason being, when I produce the data, when I produce the information, it has certain objective, it has certain target. So without target and objective, it cannot be merely produced in verbatim. So it has to have some meaningful purposes while disclosing it. And in order to create the value, unlocking the value, it has to be produced. So informed decision making, what happens in order to develop that culture inside the company, the benefit that arise from the informed decision is that it first removes the bottlenecks of misunderstanding. Second, it increases the productivity. Productivity in the sense, like say, for example, when I have to produce something meaningful to the stakeholders, when I have to produce the some reporting, when I have to disseminate some report to the stakeholders, what I'll do, I will try to make the report a complete one, which will have all the informations in place and a quick report on time because the real time basis reporting is very much required. It should not be like, say, for example, some incident has happened inside the organization. We know with the regulation 30, we have to be very particular about the timelines for the informations. So merely just something has happened and I need a time of or a time period for the evaluation of that incident to identify whether it needs a reporting or not is not the requirement or is not the expectations of regulator. What they expect is the real-time basis disclosure, which means making the market very clear and transparent and the informed bid decision so that they are up to date with the latest development. And that is what the requirement of informed decision making. This is the second principle. The third principle comes the regulatory compliance. Obviously, regulatory compliance, I will say it's so meticulous. It requires, here I will say one has to adhere to it without any deviation, without any compromise, without any second thought. Because the reason being, while reporting, everything is good, transparency and accountability, informed decision, winning the investors' confidence, stakeholders' engagement, all forms a part of it. But equally important is the regulatory compliance. Like there are so many cases. One case we all know that the ROC Goa has held that even for non-quoting the dean, not only the ROC Goa case, I would like to highlight there are apart from this Wind World cases, there are so many cases where not for quoting dean, the directors were penalized because of the violation of Section 158 of the Companies Act 2013. So, see the consequences that non-compliance with the regulatory, which the ROC takes stands from the time to time, not only one cases, but for the other cases also. Like, so what I want to highlight here with the regulatory expectations or regulatory compliance is that one should adhere to the best practices, best standard, apart from the compliance. If you adhere to it, the benefits you can have is the avoidance of penalty. And second, it develops a brand image. That's a positive point comes out from the regulatory compliance principle. Then comes two more principle, the one being the investor's confidence, other stakeholders engagement. Both are correlated. See, how can you win the investor's confidence and stakeholder engagement is very important. Because nowadays, the main challenge we face is from the proxy advisors throughout the year that you have no proper communications and disclosure, and later on you come across certain observation becomes a problem for you from winning the investor's confidence. So, in order to minimize that risk, the practices that you develop inside is to assess that what actually the systems are there to make sure the investors' engagement is there with the company, be it like in terms of a stakeholder survey. Like many companies do organize vendor suppliers meet. So there you form a kind of a stakeholders engagement with them. They're winning the confidence of theirs. Then obviously the people companies are seeking the shareholders survey in order to see whether the grievance redressal mechanism what they have in a place is whether up to the mark or not, whether they are able to redress the investors grievances in time or not. So they are using the same from time to time. Maybe it's annually, maybe it's like once in 2 years. But this is the good practices of doing some survey, engaging yourself in a kind of a engagement with the stakeholders, investors, be it through interactive meet, and for the investors, be it through the shareholder surveys, etc. Making your website more friendly for the investors corner sections, giving them single point reference, because SPR is also become a very important nowadays. Instead of going through too many pages and finding out what actually they are looking for, is like can be minimized through by providing SPR, the single page reference, where they can find all the informations forms relevant for the investors for the updations of their detail, for participations in the meeting. Because what ultimately shareholders are looking for is a favorable perception regarding the balance risk and expected return. And the second thing that the what is the assurance from the company about their investment. So once this is in place, the benefit that company will have is in the value chain establishment and the governance concerns minimize. Because the main rumor is from the investors. Once the news in the market, it is all that the corporates fear from the investors that they can have hundreds of thoughts in a single mind, and it can multiply in a radioactive kind of element. So in order to curb that, it is very important to focus on these two elements, the one being the investors and the second being of the stakeholders management. Because this like keeps the company engagement with the building networks and also focus on the company of operating at the optimal operational performance. Why reason being operation? When you meet or periodically interact with your stakeholders, what happens is that your stakeholders get a confidence in dealing with you. So thereby operationally the challenges get minimized. So after discussing this, what we can summarize is that the best practices is that you are being a fair and transparent, be it a material positive and negative, be it in all. It should be real-time basis to avoid market manipulation. Complete and concise to make it more productive, because to present a holistic approach of the company, you need to be very clear, concise from the perspective of corporate reporting. Then presenting the actual facts, which really is required for the insight, because this actual fact is again very important. When I'm talking about this actual fact, the data accuracy is very important. In one of the case of Lions Coordination Committee, what happened is that there the board meeting details were not provided. Though gap between two board meetings was provided, but they somehow missed the data relating to the board meeting details. So actual facts were missing from that report. And then because of that, the officers were held liable. So see how much this actual data is very important. When I'm saying the complete oneness and the holistic approach, it is also required in one of the cases of Politic India. What they have disclosed or what they have failed to make a clear to the market is failed to address what actually they were missing, that the auditors have given a qualifications in their report. Now, they were not able to, the directors failed to give their remarks or the statement on the auditor's report. Now, this is which there were penal consequences on the company. So, see, just because everything was in place, even the auditor's report forms a part of the annual statement only. So, you can get a clear idea from there. But it was not a complete report per se, the board's report, which is required under 134. So that's the reason that the company was held responsible. So the responsibility and you can say the duties of the professionals of the boards are very complex, considering the complex requirement of reporting, considering the complex environment of regulatory framework, right? So these are the best practices method that you should adhere to. And we all know that the regime has changed to RRR when we say the responsible reporting regime. So there are so many things you should bear in mind to deliver in the time, to deliver the increasing expectations, etc. But at the same time, there are challenges too. How we address the challenges is a very big question mark. That how we can challenge, those address the challenges. Like there can be challenges in terms of a data accuracy, challenges in terms of a complex regulatory environment, challenges in terms of a forward-looking statement, challenges in terms of a standardization of information. Because one thing one will quickly observe that, okay, whatever you are saying that we should bear in mind as a common principles for the good governance reporting or for the good practices of reporting. But then how to address those challenges which we come across of late in nowadays. So as far as the complex regulatory environment, I will say the complex regulatory environment because of the law, what we have discussed, the provisions, I don't want to get into like be it a SEBI 15A, be it a Companies Act 129, 134, 135, be it the SEBI LODR Regulation 4, Regulation 23, Regulation 34, Regulation, and then read with the Schedule 5. Their all expectation is more towards a disclosure from our side. So I know that the complex environment is there, but the complex environment can be mitigated by way of having an internal, very robust control, or you can say system to comply with the legal requirement, be it in the form of a checklist, be it in the form of prospect note, be in the form of a quite periodical interactions for the regular updations, because this only can minimize the risk or the challenges of complex regulatory environment. Now, coming to the data accuracy, in data accuracy, I have a very good question because sometimes a common question comes, how much is too much? So that means no one knows where to put an end because the kind of information that flows, even it becomes very challenging when we are giving the quantitative reports like BRSR, sustainability report. In those reports, boasting on those statements without factual check of data becomes very important. So reporting everything under the sun, we all know overwhelms the stakeholders, but it has certain demerits as well with its accuracy. And in fact, there are many judgments where because of the inaccurate data, like I just mentioned about the board meeting intervals and dates, the penalty was only because of the inaccurate data. So how you can change that concept, like because the requirement is to disclose the material disclosure, material information. It is not, I'm talking about Regulation 30. It's in general parlance, in the general sense, the colloquial word, the word journal, material, that material information you will provide. So don't get it overloaded with the number of informations. Your periodical, your concise focus should be on the relevant and material information. Now, question comes how you can address this challenge. Have some good implementation of data governance practices. Make sure that the data are secured, data are validated. In fact, alignment of data output across the system and the organization is very important because whatever the raw form of the data originates, the output has to be uniform then in order to rely on it. So these practices should be developed by the organization to address the issues which pertains to the data accuracy. The next common challenges which the organization come across is forward-looking information. So in forward-looking, there is a common belief in the corporate's mind that many companies are having the fear factor from the increasing demand for forward-looking information. They believe that the forward-looking informations they provide, the more vulnerable they are to risk. Yes, I obviously agree that they are vulnerable to it, but it brings the profit as well. It brings the business as well to the entity. It has a lot of good features as well because it enhances the business understanding. It robust the governance and put good practices when you are making forward-looking statement, achieving those targets, and winning the confidence of stakeholders. All these three supplement one after the other, make yourself in a distinguished position in terms of your corporate reporting to the outer world. But while making the forward-looking statement, you should have certain factor in mind. Like the forward-looking statement, I correlate it with the NSC guidance note, which I just shared few moments back, maybe half an hour back, the June 21, which deals with certain do's and do nots. So there also it clearly outlines that whatever the data, forward-looking information you are sharing should be supported by information, resource, or source of information. So that should be in our mind as well. While making such a statement, we should make only the forward-looking statement where it is necessary and where it is required. In fact, there are certain few success, you can say, mantras for forward-looking statement also, like seven pillars. So, what are those seven pillars you have to bear in mind? Like one is that explain the resource available to the company. So you have to see that whatever the resource you are available, you are explaining it in a lucid manner or not. Let's say, for example, in few of the board's report, you will find in some of the examples or some of the present this reporting, you will find that there are reportings about the strength of employees, strength of internal control, strength of IT system. But there you need to give the quantitative numbers as well. That what numbers of employee, what numbers of dedicated team, or what actually the percentage of resource you are having it. So you give the resource, principal risk, the significant relationship with the stakeholders, inform about your KPIs and its importance, what actually your KPIs, key performance indicator targets are. Link it with the what the output or what the business like the output you want to give to the outer society. So that becomes very important while presenting the information. Next, continuing is with the same as the standardization. So standardization, as I already dealt with it, that this is basically nothing but uniformity across all the department. And this facilitate at least a proper dissemination of information to the outsider world. So these were the challenges. Now we all know the emerging trends of the corporate reporting while we discussed. There are various forms. Few of them are very important, like emerging. You can say integrated reporting is coming nowadays. ESG reporting is a much hype news. Technology-driven reporting, non-financial metrics, they are all coming into. These are the emerging threats with which we should be equipped with. Like if I talk about the integrated reporting, it has its own like benefit. It gives the core focus on the business elements, governance. It talks about the strategy, risk, and opportunities of the company. It gives the outlook about the company and the governance practices as well. There are so many benefits of integrated reporting. The people do benefit from the enhanced communication because then your target audience is not shareholders only, it's the stakeholders. It improves the decision making because inclusive, your customers, your vendors forms a part of it. It also develops the organizations or helps the organizations in building up a long-term value. And then obviously at the same time creating a transferable or sustainable footprints for the company. So these are the new trends, the benefits of integrated reporting, which we should adopt to while publishing our annual report. The more encouragement towards the integrated reporting should be. But at the same time, there is a new another concept of ESG trending. Why? Because the ESG trend, we all know that we are adopting it maybe a bit late, but in a very exhaustive way. So perhaps if you look at the reporting framework, we have been so fast, we have been so like quick adaptable to those ESG changes. Though the European, the UK, they are still there, though they are having the law, but then there again, the law is basically focusing more towards the disclosures only, nowhere dealing with the penal consequences. While in Indian regulatory framework, we are having the penal measures as well for non-complying with those. As far as ESG is concerned, though at this stage it's voluntary, Companies Act doesn't mandate anywhere for the purpose of ESG reporting. But yes, SEBI LODR has taken a step ahead. In July 2023, while coming out with a circular, SEBI has mandated. that top 250 company can start on comply explain basis from the financial year 25, 24, 25 onwards. And thereafter, no doubt that that is what is coming to it, that we are fast and quick adaptable. Means not only this, after this, from 25, 26 onward, we have also requested, like the SEBI has requested for the companies to come out with the assurance on those ESG core. So that means giving too much of focus on our ESG metrics in the days to come. And there will be a lot of benefits are going to be coming out from the ESG benefit. It will also make you accessible to the global market to be on the global indices because of the ESG matrix. There are another emerging trends like technology driven. So technology driven trend, I will say it is basically to meet the requirement of fast evolving change of technology. So if you look at the recent change of LODR, also see where they have also adapted the recent changes or changes in technology. They are mandating that even while publishing the results, detail, QR code, web page, etc., can be given. So that means a quick adaptability to technology, the social media presence, the presence through the technology advancement, the advancement of your system, making your company, making your entity front runner in making real-time discourses. So that also becomes very important. And as far as non-financial metrics is concerned, I think enough we have discussed about this. So at the end, while summarizing, if you will, people will have any query, I'll come to that non-financial metrics. But that's we all know that non-financial metrics is the real realm of the corporate world, which necessitate the entire corporate reporting framework. Now, quickly before we summarize, just to have a look, like at times, like when we look at the best practices of corporate reporting, we should look at the devil side also. There are many consequences of giving the fraudulent reporting, giving the false reporting. So there is a difference between fraud and fraudulent reporting. If I say fraud reporting, there is a clear-cut function under section 143, subsection 12, and deals with the another rule 13, which is for the accounts rule, where you are required to report the fraud in the form 84, etc. But fraudulent reporting is something which means a false statement. When a person is making, he knows that it is a false, or he doesn't care to know whether it's a true or false. So recklessly, carelessly approach towards a statement can tantamount is as a fraudulent statement. So there is a clear-cut definition. So knowingly, without belief in truth or recklessly, carelessly, if you are making any statement or reporting, it will turn into a false reporting. So that you should bear in mind because it has got a legal repercussion also. It is very important to understand that what actually the false statement can be. Because ultimately, the false statement, whether it's a 447, 448, 448, 449, they all will turn into a fraudulent action and which will be taken under 447 against the entity and the person involved. And there we all know the imprisonment starting from 3 to 10 years and the fine going up to the three times of the amount of fraud. And in certain cases where the lesser kind of a like then the threshold of which is there prescribed in the 447, if it is lesser than that, then yes, obviously the fine and the your imprisonment gets reduced. But nonetheless, it's so huge at the first go. If your company, if your the professionals are engaged into such fraudulent activities or fraudulent reporting. So reporting per se will look like a false statement only. But the false statement can result into fraudulent reporting because it fraudulent reporting, if you look at this segment, I'll say it has three baskets. False, inadequate, omission. So even if you're giving a false statement means any information or statement which omits the real information. You have suppressed, then it means you have given some assertion which is untrue, which is not true, or you are creating a false impression. All will lead to falsification. And misstatement is also a false statement. And inadequate, we all know that when you are give the incomplete picture, when you do not want to share the complete picture, when you are omitting some information, they all result into a false reporting. And there are so many sections. These sections are just for your reference. So I'll run through this because these sections, like n number of sections are there, almost 15, 16 sections, be it 7 incorporation, section 8 company, 34, 36 with the prospectus, 30, 75 deposits, 90 SBO. SBO, we have seen two, three cases where there has been a huge penalty. But of course, it has not come into the fraudulent because one thing you should notice while saying about these sections also, one quick observation I would like to make. It doesn't mean that, say, for example, if 90 says very clearly that there will be actions under 447 for non-compliance with the section 90. So I will not say that it is directly for fraudulent because in that section also there is a subsection 11 where there is a penalty of separate amount in lakhs is there. But if there is a false information, then the focus it shifts it to fraudulent reporting. So that we should bear in mind that fraudulent reporting will emerge first with the where there is a deceitful manner of making the false statement. And in the false reporting, I would like to quickly highlight few of the cases. Like we all know, if it is not material, not damaging, you can take a plea. Like as I said, section 90, you have not disclosed it. So simply getting a penalty of lakhs is good enough. But if it is a material damage, it will be turning into a fraudulent reporting. And if you look at the cases, like one or two cases, the directors has given a statement. Directors have given in director's report in the BRR segment. And interestingly, in this case, the BRR was voluntary. And in the voluntary report, they have given a wrong confirmation that there were no show cause notice pending against the company. And MCA penalized. Later on, the company was having a plea that, see, we are having the voluntary adoption. So what? Even if you are adopting voluntary, it should have the essence of transparency. So it was held that your BRR under the relevant sections were misleading and not amounting to proper and, like you can say, fair and true view. In fact, it amounted to misrepresentation and thereby holding the entities and the persons responsible for the false reporting. Similarly, in a similar case, like another case, SEBI has held a person for giving a wrong qualifications. Like, though this degree was there from that university only, but that university name was changed, that university's accolades were different, and that were not completely reflected in the IPO statement and IPO prospectus. The directors were held responsible for giving some false reporting. Similarly, the false is different. Fault is with the connivance of mind. There might be some incidences where you are not able to complete provide the information. Like in one of the cases, the MCA has held that the companies was required to give a disclosure pertaining to the group companies, subsidiaries, etc. Cost records statement, and these details were not provided. So, pending the incomplete information, Section 134 and read with Rule 8, Sub-Rule 5, these companies were penalized for giving the incomplete information. There are two, three precedents also where the company has not highlighted the findings of statutory auditors. The company couldn't provide the statement of investment of the subsidiaries. So in these cases also, because of the inadequate reporting, there were penal actions on the company. Sometimes there might be one more thing that technical issues in reporting. Some people say it's very calm or I will say from the SEBI perspective also, we can have a quick a lot of discussion on the technical round because we all say that if it is not getting uploaded, technical thing is a very correct thing. So the law, though, no doubt, Apex Court has a judgment that every venal or technical breach cannot be penalized. But it has to be seen with the whether the act is for the defense of law. So if it has got that defense that yes, and there has been no proper exercise of due diligence and care, that means this technical breach was bound to happen because of the negligence. So if that negligence has proven, there will be actions reported on this. And I will not like to make you people afraid of so many penal consequences because I know that reporting has a more good sides rather than having the bad sides. So there are penal consequences under SEBI as well. But then depending on, see again, I will say very honestly one thing. The false statement per se is not a false reporting, per se is not fraudulent reporting. Once this has been proven, and in fact, this is the reason you will see that when the market comes across some false reporting, there is an inquiry set up because apparently it may be false, but to make it fraudulent, there needs proper inquiry. And yes, obviously, for those reporting, there will be several actions. In fact, one quick question before we come to conclusion is that people do talk about Regulation 30. So, Regulation 30, we all know there are so many timelines. And I know the pain from my colleagues also because keeping these timelines in mind is very difficult. Keeping this process, internal robust control inside the organization is very difficult. So sometimes there may be gap, there may be misreporting. So how to address those issues is a quick question. So whether there will be several consequences, I'll not say several because again it depends that whether the intent was to defray the investors from that information or not. Like there are two, three cases. One is about this TV where they could not disclose the information because the matter was sub judice as far as the voting results was concerned. So then they settled this case. It was not tantamount fraudulent, but yes, obviously it was tantamounting as non-reporting or delayed reporting in compliance with the regulations. Similarly, there is a case of Urja Global where what happened, they have entered into an agreement with the prospect investors. Later on, they found that this agreement itself is bogus. The persons who have signed as signatory have no such authenticity or no authorized signatories to that agreement. But what the judgment of the SEBI or view of the SEBI was that this information at least should have been disclosed rather than suppressing it. Rather than not making the people aware, you could have made the people aware that this is the scenario, actual scenario. So what ultimately the key takeaways are that be it good or be it bad, but we should make it clear to the market that yes, these informations are placed, they can take or they can then benefit from these reporting. So this is what back actually I wanted to cover that this corporate reporting, how it starts, what the fragments of corporate reporting in the present regime are, financials, non-financial, regulatory bodies controlling those reportings, regulatory frameworks, the responsibility of the board, committee, management, professional, and then certain principles that should be bear in mind. And then lastly, with some penal consequences where we have come across so many of fraudulent, false, etc. reporting. At last, I would like to conclude this session with saying thanks. And before I conclude, I know I'm open to queries. I will open the floor for queries you can have like whatever we have discussed for last couple of hours. I will conclude is that corporate reporting is not dealing with the objects. People do think that at the end, this is the summarized takeaway that it's not about all dealing with the objects. Rather, it is more about the relationship between the two objects of context. So, what you disclose, the relationship with that context should have been built up properly in order to make your report a very crystal clear and the concise one for the investors. So, with my these words, I conclude myself here, thanking you again. Thanks. And over
Thank
to
you,
you, Susan.
sir, for this detailed presentation. And most of the queries as posted by the members are already been answered in these slides. But we have some of the queries which I like to post before you. One of
Yeah,
the
sure.
query is, what are the best practices for ensuring timely submission of statutory reports to regulators?
The best practices again, as I said, the real time, the essence, the real time basis disclosure has become of much utmost necessity. So, in order to meet those timely, first is that the identification of the nodal departments in your organization is very important because at times when something happened, running from door to door of a one department to another becomes challenging. So that identification should have been in a place, and there should be a spoke, a single person of contact for each and everything, because then having a multi-layered segment results into delayed disclosure. And there should be clear-cut demarcations apart from the policy. We all know the determination of policy or the disclosure policy, or even if they under the Companies Act, there is no policy. But then If it is only interested with the KMPs, below that, there should be clear cut, you can say process note, internal process note to make sure that this ammunition goes to the market in time. So these are the three things that one should bear in mind while ensuring the practices of, you can say, timely disclosure to the bosses or the stock exchanges.
Sir, another query we have is if a private company voluntarily report anything or disclose anything in a particular year, is it mandated for that company to disclose such information every year?
See, if I go by the regulatory framework, the regulatory prospects of view, I will say no. You are not under a compulsion to continue that disclosure. But from the voluntary approach or corporate governance practices, I will say yes. Because the reason being, once you have informed, the continuity of such information is much more required for the investors at large. Once you say, for example, like I will just give a correlate with the example. Once you start giving the chocolates, then you cannot go or settle for the like once you started with a dairy milk and all, you cannot go to the lower version at thereafter.
Yes.
So that's a common phenomena which we use for the investors as well. So when you give the informations in detail, maybe about a particular segment, you can't settle down the next time without giving the information, because then it looks like the omission of information looks like that completely the organization has ignored it, and that should not come out.
Sir, another query is how can companies ensure credibility and avoid greenwashing in ESG disclosures, particularly?
Sorry, come back. Avoidance of greenwashing and
Uh, can ensure credibility and avoid greenwashing in ESG disclosures, particularly.
so see again, I will go back to the transparency and accountability factor while ESG we are concerned. See, in greenwashing, as I was telling you, in greenwashing, what basically we do, exaggerate the statement, exaggerate the what actually the footprints of the companies are. So 100 pages book you are selling outlet with a single sided page print, or you can say making it a 200 or voluminous. That is what in the greenwashing we are doing. The best way to avoid it is that, first of all, bear in mind that ESG for the time being is a voluntary comply or explain approach basis. So there is no such legal consequences or penalty or fine arising thereof. Second, at the same time, yes, obviously, correlatedness of data should be there. Because while, say, for example, as I just mentioned about one case where show cause notices were pending. So you should know if there is something like that, there are some like non-compliance with respect to the environmental issues. Don't boast on that. Don't highlight that, because that will not tantamount to the greenwashing or greenwashing. So be true from your side, reflect what actually you are doing to, and then make a concise report, because it is not necessary. At times we go about, but having a validation, or you can use the validations from the external party also. Like hiring consultant also is a good practice to have the validations of what you are reporting, considering the industry you are operating into, considering the companies comparable you are to.
Sir, these are the main queries that are to be discussed. And now, with this, I would like to have a formal vote of thanks. As we come to the conclusion of this session, I would like to extend my heartfelt gratitude to our distinguished speaker, C.S. Ravi Varma, for his time and sharing his valuable insights and expertise with us. So, your valuable insights have significantly enriched us and all the members with the gateway to governance in the form of corporate reporting best practices. I would also like to express my sincere appreciation to all the participants and the attendees. Your engagement and enthusiasm is truly make this webinar meaningful and successful. Thank you once again for your support and presence. Thank you so much, sir, again. Thank you.
Thank you. Thank you so much.